Good morning, everyone, and welcome to Managing Your Cash During the Crisis. This is the latest of BizWest's Business Strategies Coping with COVID-19 webinar series, and I'm Jeff Nuttall, publisher here at BizWest. COVID-19 has wreaked havoc globally with more than 4 million infections and at least 286,000 deaths, including nearly 146,700 in the United States alone. In Colorado, the latest numbers reflect about 45,314 cases, including 1,679 deaths. And while the economy has improved of late with the opening of most businesses, we still have seen an uptick in the virus. Today, we will hear from some of the region's top financial experts who will provide some best practices when it comes to managing your cash. But before we begin, I want to remind everyone that we will spend about 15 minutes on Q&A after the presentations concludes. Please use the question and answer button in the Zoom bar and post those questions, and we will retain those and try to get them answered for you before we conclude today. Also of note, we will be sending all of today's participants a survey about the webinar because we want to know what you learned and how we're doing. And in that survey, there will be a link to the recordings as well as copies of the presentations that you're seeing today. Our sponsors are Moran and Vectra Bank, and we thank them for being a part of this. And our panelists today are James Drabansky, who is the CFA partner with Moran, Tyrone Gant, who is Senior Vice President and Directory Treasury Manager at Vectra Bank, and Rory Jaret, Vice President and Accounts Receivable Relations Manager with Vectra Bank. Welcome, gentlemen. And we're going to start off today with James Drabansky. And James specializes in business valuations. He helps clients achieve the most accurate and favorable valuation and complete the optimal deal for each specific situation. His clients include food and beverage companies, primarily in brewing and health food space, residential and civil construction, engineering and architectural firms, and various niche industries. Expertise includes facilitation of shareholder buy-ins and buyouts, estate and gift tax planning, and fair value reporting, as well as modeling complicated instruments such as non-vanilla warrants and consulting with clients on operational value drivers. Ladies and gentlemen, please welcome James Trovansky.
Thank you, Jeff, for that introduction. Good morning, everyone, and thank you for joining us today. I'm happy to be discussing this important topic, managing cash flow and cash during the COVID-19 crisis. As part of my day-to-day work life, doing business valuation in various industries, we deal and I look at cash flow every day. And so I understand and see the value of cash flow and really how it impacts valuation of businesses. And at the end of the day, business valuation is directly linked to cash flow generating capacity and risk. So this is an important topic for any business owners who are thinking about exiting in the near term or medium term, probably medium term given the crisis. And it's really kind of critical to the lifeblood of a business. I know we've all been faced with new challenges, managing kids while working, going stir crazy at home. And unfortunately, I don't have any tactics for that today, but I will discuss tactics for keeping your business liquid. A little bit about Moran. The company was founded almost 100 years ago. Moran is the 11th largest accounting firm with over 3,100 professionals and 25 offices worldwide. We serve our clients by delivering financial, tax, and consulting expertise throughout the business lifecycle. I work in our consulting services group, which provides a wide range of services, including cybersecurity, enterprise data management, and specialty tax services, just to name a few. Our consulting group has grown dramatically over the last 10 years, and I'm really proud of the diversity of services that we offer. Okay, so today, here's an overview of our discussion. There's so much uncertainty in our world, but I'd like to focus this presentation on the opportunities and areas that we can control. A lot of the impact of COVID-19 is out of our control, but the efficiency of our operations for our businesses and the cash management and customer management, that is within our control to a certain extent. And the goal here is to arm people with the best strategies to maintain liquidity and improve cash flow as much as possible. So we'll cover some of the best practices for managing and improving liquidity, focusing on strategies around costs, customers and AR, inventory, and vendors. Most companies have probably already addressed many of these areas, but hopefully there are a few strategies and nuggets you can deploy quickly to continue to drive liquidity. And finally, I'll discuss some strategies around improving your chances of successfully emerging from the crisis. I will also note you'll hear the term rationalization quite a bit today. And it really is exactly what it sounds like. Rationalizing your inventory is really the process of taking a deep dive on it and making sure that the inventory structure and the inventory on hand is rational and related to your business plan. And we'll go into that in more detail. So true liquidity management requires more than just managing your expenses with your revenue. Liquidity requires managing operations and balance sheet to drive cash flow. As you can see in this diagram, the income statement is one part of the equation, but the balance sheet is also another important component of cash flow, and sometimes overlooked. Many of you have probably heard the adage, revenues are vanity, profits are sanity, but cash is reality. Cash flow is a primary driver of business value, and revenue growth is not an indication of cash flow. You cannot judge liquidity of your business based on the revenue growth. In fact, typically fast-growing companies have some of the most serious cash flow problems. Moving down the income statement, profits are a better indication of economic return of a business, but not an ideal benchmark for liquidity. The reality of a company's success and liquidity is cash flow and cash in the door. And that's how I assess businesses every day when we're looking at from a valuation perspective. What is the cash flow capacity and how is working capital impacting that? So Plante Moran surveyed our clients recently to gauge their concerns in various areas, including liquidity. Most felt very confident that they had the tools and processes to manage cash flow. However, they were less confident around their ability to collect receivables and thereby pay their vendors. Interestingly, the lowest confidence rating was their ability to recover. So let's get into it and share some ideas that can be deployed quickly to hopefully increase your chances of recovery. So the first area I want to discuss is customer management, and this is really around accounts receivable. When considering customer management, the key to liquidity is accelerating collections. To accelerate collections, monitor AR aging is important and must be done frequently. As we all know, old AR is much harder to collect. By keeping close tabs on AR with a systematic approach, companies can prevent the deterioration of their AR and limit write-offs while improving liquidity. Some other areas to consider, and I do have some rather dense slides here, so I'm going to kind of hit the key points. Settling disputed AR frees up employees to focus on more pressing matters and provides at least some cash in the door more quickly than a drawn-out dispute. So if you're in a situation where you have a drawn-out dispute already with a client, it may be best just to settle and say, look, let's just put this behind us. We'll take a fractional payment. You get some cash in the door and you free up your employees to focus on more pressing matters. Bringing salespeople in to assist with collections is really important as well, especially for a difficult collection. Salespeople generally hold good relationships with customers and can be influential in the collection process. The downside is your salespeople need to be out selling, especially in this environment. So use of your salespeople to assist in the collection process should be done strategically and not across the board to the point where your salespeople are being distracted and it's impacting their sales ability. Also, consider factoring receivables to reduce the burden on employees and accelerate collections. Rory is going to touch on that later. Performing a customer rationalization analysis. High volume, profitable, or strategic customers are a priority. While slow paying, demanding customers, you may want to consider how they impact the capacity of your workforce or your supply. And is it time to let them go? And this is a theme we'll also see with inventory. Sometimes it's better to have less profitable business than a more unprofitable business, obviously. Inventory management. Now, this is key. I always view inventory as kind of, it can be really cash just stuck on the balance sheet if inventory purchases are not done efficiently. I've talked with a lot of business owners who almost get a peace of mind by buying a lot of inventory they know they're going to use. And that's fine during a strong economic environment. But in a situation like today, where I think I saw a headline where GDP decreased over 30%, in environments like today, keeping your inventory lean and mean is the best practice for managing your cash flow. So this slide highlights some of the best practices. Determining standard inventory turnover by item to better set reorder points. Knowing exactly how quickly inventory is used may provide more insights. Efficient reordering prevents cash flow unnecessarily being held up in inventory. So if you've done analysis and you understand the turnover of your inventory, and perhaps there's a seasonality to it, you can better predict your ordering needs and streamline that better to maintain more cash. Require better demand planning from your team so you can sync production plans with demand and purchase only inventory you need. This is more on the raw goods side for a company that's doing production. I think it's important in this environment to demand better demand anticipation from your team. If you're able to really kind of nail that down, you can reduce your inventory and sync it with the production. Reducing vendor lead times can also allow for more just-in-time ordering, reducing large purchases and the associated risk that demand won't materialize. So if your vendors can commit to faster delivery, then you can delay inventory purchases further as you assess demand. Also, look for and liquidate slow-moving or obsolete inventory, and consider if these product lines should be discontinued. And this is good, just business practice. I did due diligence for buy and sell side for about 5 years. And whenever we looked at a company that had an inventory component, we always did analysis on slow moving and obsolete. And we would ask management about those key items. So the more you have those items in tune and optimized, it's going to accelerate your due diligence process in the event of a sale. But for purposes of this presentation, it's really going to help find inventory that can be liquidated to improve cash balance that can be reinvested in the company in other areas. So inventory rationalization. I really like these concentric circles chart. I think it visualizes the process really well. Myself personally, I'm a visual person, so this helps me. What you can see here is that you have three main buckets, if you will, for your inventory. Your profit of your inventory, the volume of the inventory, and the strategic value of your inventory. And you can also tailor this to a services business. Your profitable service lines, your high volume service lines, and your strategic service lines. For example, if a SKU is low volume, not profitable, and not strategic, then liquidate it and stop selling it. Same goes for a service line. There's no value to a company to do a low volume, low profit inventory, especially if it's not strategic. SKUs ideally will fall into at least two of these categories: profitable, high volume, or strategic. It's also important when you're doing an inventory rationalization to really challenge any products in the strategic category. Now is the time to take a hard look at these and question if these strategic products or services still fit with the long-term vision of your company, especially given how COVID-19 may have changed your long-term vision. Ask yourself, has the strategy changed? And if so, how does this impact the composition of my inventory or services? So the goal here really is twofold. Keep your inventory purchases as low as possible and identify inventory that can be liquidated to free up cash. Vendor management. This one has its pros and cons and needs to be done carefully, but it's critical to liquidity management and supply chain risk management. Key practices in vendor management is communication and negotiation. The goal is to extend payment terms and lower pricing if you can. But also be careful to monitor vendors' ability to survive and supply what you need to deliver your products or services. Your vendors are likely facing similar challenges, so give and take is a must. What we've been seeing is net 60 payment terms are becoming pretty standard in the US, with some companies able to push out to 90 days. So if you can push out your vendor, you want to push out your vendors as much as possible. Explore opportunities to return excess inventory. This is likely industry specific, but worth considering. In addition, bad economic climate can create opportunities to diversify vendors or find vendors with better pricing. Struggling vendors may be willing to provide better pricing, but be careful not to jump in too quickly because you don't want to be reliant on struggling vendors. In addition, diversifying vendors can be a great risk mitigation tool, ensuring a smooth supply chain. In my world, we always inquire on vendor diversity when assessing a company's overall risk profile, especially for inventory or very niche markets where there may not be a lot of vendors. It can be a significant risk if you have one vendor that you're heavily reliant upon. So it's good business practice, and it's also good ability to negotiate terms when you have two vendors that you can negotiate against. Okay, additional liquidity management items. So some other areas to consider, including understanding the sensitivity of making any changes. Are there long-term implications? The last thing we want to do is go into this process of preserving cash and enhancing cash flow to the detriment of the long-term viability of the company. So there's give and take. But we do want to take out costs wherever possible. With respect to employees, we need to evaluate and act quickly to reduce costs. Scalability is key, but don't staff up too quickly when you start to see the recovery. This will require all employees to wear more hats and really to kind of take on new roles. But long-term, this could be beneficial because employees will have a better understanding of the function of other departments. So we'll touch on this in the next slide, but the COVID-19 crisis really can create a situation where you are forced to become more lean and better cash flow managers, and also expand your employees' understanding of your business, so that when you come out of the crisis, you have a stronger workforce, albeit smaller, and also improve best practices for cash flow management, which when combined with increased demand in a recovery situation can really cause firm values to skyrocket. Also consider if you have commission-based employees, commission plans ideally should be based off of profit, not revenue. And if you can, it's best to pay commissions when the customer pays, not when the sale is made. That way you're kind of linking the compensation of your commission-based employees to the timing of the cash flow, which is the main goal. You don't want to be paying anything out until you've got paid by your customer. Regarding fixed assets, to drive liquidity, defer capital expenditures wherever you can. Monetize underutilized assets, meaning sell them, and negotiate terms with landlords. Also, with the low cost of debt, purchasing critical assets with debt may be a good option. But again, with that give and take, we don't want to take on too much leverage in a situation like this. But if the cost of debt and the terms are right, and it is a really critical asset, it may be a good option to preserve cash. So necessity is the mother of invention, and the current crisis can be the impetus for systematic change, which can create a platform for restarting. The COVID crisis can serve as a catalyst to make transformational changes in your business. Find the services or products that can be cut and focus on driving the strategic and profitable services or products. Don't spend time with low profit customers that demand a lot of your time. Improve utilization of your people and assets, demand more from less people if you can, and liquidate underutilized assets. But don't stop looking for opportunities. Keep an eye out for competitors that may go out of business or be struggling, and capitalize on potential new clients or business lines. The COVID-19 crisis, as weaker competitors struggle, they may lose customers, and there might be customers out there looking for an alternative. So keep your eye out for that. Also, the M&A market is we're likely to see more activity coming out of COVID. So keep your eye out for potential targets or potential buyers if that's part of your strategy. There may be opportunities to buy struggling competitors at a discounted price. So keep an eye out for those potential acquisitions. This slide is just a high-level crisis management framework. And really the goal here is to be systematic about your approach. So phase one here, responding. That's what we've been talking about. Ensuring your employee health and safety is critical. Determining financial liquidity position. Where are you liquidity-wise? Do you have a model, and do you understand with your current position in a worst case scenario, how long can you survive? Understanding that can really help drive your strategy. We've talked about deferring costs. Communication also is something we haven't touched on. Communicating with your customers, your vendors, your employees, and your stakeholders. Let them know what your plan is, and depending on which group you're talking to, have a frank conversation about how you can both help each other to manage this crisis. And of course, consider legal implications. When it's time to reinitiate the business, that's when we start reactivating new employees, bringing people back or continuing to hire. Really spending time with your customers. When it's much easier to meet in person, unlike today, get in front of your customers and kind of rebuild those relationships. And then with your vendors, rebuild those relationships and strengthen your supply chain. And then finally, the reform. So recapitalize. If you took on more debt than you're comfortable with during the crisis, maybe it's time to start kind of chipping away at that. Customer rationalization, human capital, accessing operational technologies and efficiencies. Really, that's when you're kind of hitting the ground running. And then I'll just touch on cash flow management and business valuation. I've kind of been sprinkling that in as we go. But cash flow management is directly linked to risk. So when I'm talking to business owners, we ask a lot of questions around vendor management, accounts receivable, collection processes, staffing in your finance and accounting department, just to name a few. So these practices that we are talking about here outside of a crisis reduce the risk of your cash flows, and reducing risk of cash flows increases the value of your business. Also, if you're considering a sale, these practices can help reduce due diligence adjustments. When due diligence teams come in, they're going to look through your inventory and they're going to say, this, and this is all obsolete. We don't want it, and it can cause adjustments. They're also going to look at your AR in a similar fashion. The cleaner and more efficient you are in your cash flow management and your cash management, the smoother your due diligence process is going to be. So that's my thoughts on cash flow management and maintaining liquidity during a crisis. Thank you for listening and joining us today, and I'll turn it over to the next panelist.
Thank you, James. Lots of good information there. Our next panelist is Tyrone Gant, who's Senior VP and Director of Treasury Management at Vectra Bank. He has 30 years of experience in the financial services industry and is keenly focused on helping middle market commercial clients meet their financial objectives. In his role at Vectra Bank, Tyrone leads a team of treasury professionals that partner with businesses to manage liquidity and cash flow cycles. His specializations include strategic planning, business process improvements, business transition planning, and complex treasury management. Welcome, Tyrone. It's all yours.
Well, good morning. Thank you, Jeff, for that very kind introduction. Hopefully you guys can hear me very well. I'll just start off by saying it's a privilege and honor to be here with you guys today. In the sake of transparency, I will admit that this is my very first time presenting to an audience in a virtual environment. I'm used to a live crowd that laugh at all of my corny jokes. So hopefully I will just have to trust that as I start dropping these corny dad jokes, you guys are laughing in the background and appeasing me. So with that being said, I'll just get started. James, thank you very much. Covered a lot of the topics from the customer's perspective. and I will take some time today to explain how we in Treasury partner with our business clients, our customers, to help them maintain and manage liquidity. Treasury in its most simplistic form, the basic objective is to maintain and manage liquidity. So as you can imagine, in this crisis, the role of the treasurer has rapidly increased and created a huge spotlight on the importance of that role. Just a little bit about Vectra Bank. For those of you who do not know us or have not experienced this, Vectra Bank, I've been a proud member of the organization, and I'm a proud member for a lot of reasons, but I don't want to go over my time allotment, so BizWest will invite me back next time. But one of those reasons, as Jeff explained in my bio, is to partner with customers to provide solutions to make their business more efficient and help them win at the end of the day. We are a unique hybrid, being unique that we are a part of Zions Bank Corporation out of Salt Lake City with 76 billion in assets, but we have the community bank presence and feel of Vectra Bank here in Colorado and New Mexico. So I say we're a unique hybrid because we have the capital and the power to provide solutions to those larger corporate type clients, but we maintain here locally in our local markets that community presence, that nimbleness to provide solutions to customers, to really provide that relationship banking, which is critical in this time period, as it is always. So I know James covered a lot of this stuff from the customer perspective, as I mentioned. I will cover it from the bank's perspective and how we partner with our customers to help make them successful. I mentioned in my intro that the increased profile as Treasury has really risen during these times, the role of the treasurer, the corporate treasurer, and the Treasury Department. As an increased focus on future impacts of the pandemic and on an organization's liquidity has really led to this increased high profile role for all treasurers. And we're proud to partner with our customers to help make them successful. So in today's discussion, I will highlight the importance of preserving cash and maximizing liquidity to get you through this time, or to get customers through this time, also while ensuring sustainability. Forecasting is really critical, improving on forecasting to predict what's going to happen in the future as close as you can. It's a lot better to know early now what the impacts are going to be in the future, so you can make decisions today to help get you through those uncertain times. James covered flatten expenses. I'll just talk about a few of those topics from a bank's perspective as well. And then finally, I will end on a slide really explaining how a bank partners with their customers to help mitigate risk and fraud. As you can imagine, in a crisis time, cyber criminals really see this as a huge opportunity to attack customers and people's vulnerabilities. So we'll talk about the role that we help play with those customers to help make them successful, to protect themselves the best as they can. Okay, preserving cash and maximizing liquidity. Really, in today's environment, customers are maximizing their DDA balances. DDA is also known as a demand deposit account or an operating account. Those are your accounts where you write most of your transactions off of. And they're utilizing earnings credit rates to help offset those fees through account analysis. Reason that they're doing so, typically in this type of environment, when there's a crisis, the earnings credit rate that you're going to earn through account analysis to help offset fees is typically going to be higher than what you would receive on a rate of return interest back into your pocket. So we see a lot of customers shifting their balances from interest-bearing sweep accounts, from the market accounts back into their DDA balance sheet. Number one, to provide liquidity, but number two, to make their relationship as efficient as possible, and they have the best net benefit at the end of the day as it comes to their pocket. Holding short-term investments in the bank is becoming a preference now, as you can imagine. A result of the pandemic has really created a lot of economic concerns and flexibility or fluctuation in the market, for lack of a better term. So customers are moving those short-term investments back onto the bank balance sheet, again, to maximize liquidity, but for a couple of other reasons: safety of the principal, the safety and soundness of the bank. They don't want to lose liquidity. A lot of customers that do have excess liquidity after they offset their fees are utilizing interest-bearing vehicles like a repurchase sweep account. For those of you not familiar with the repurchase sweep, the bank has to provide collateral to protect those interest-bearing deposits. So really, safety is the key word here. AFP stands for Association of Financial Professionals. That's the National Treasury Trade Organization that most of us belong to. But they did a 2020 liquidity survey, and you can see here really safety at 62% is the priority for customers, followed by liquidity, and you'll see yield is really an afterthought. It's really safety that is the primary objective of customers in regards to liquidity, et cetera. James touched up on accounts receivable, tightening up on accounts receivable from the customer side. It's really key that we partner with our customers to help them strengthen their collections by using bank products. Lots of times we recommend that customers negotiate terms. I know James brought up the issue of maybe you push out your payables terms with your vendors if you have the ability to do so. Go ahead and take advantage of that. But maybe you're able to negotiate discount terms with your vendor partners and take a discount by paying early, 210 net 30 or what have you. If you're using a solution, i.e. a commercial card, or what is also known as a procurement card, you're loading all of your payables on a card versus issuing checks or other electronic transactions. You can take advantage of that discount by paying early on the discount date, but still extending out your payables. And that way, those customers will get those collections from card receipts. Enabling digital bank solutions. It can be simple as requiring that your customers pay you via ACH and or wire. If they allow you to automatically debit off of their accounts, you can control when that ACH jumps into your cash flow cycle. You are being the customer to get faster liquidity. Again, provide credit card payments as an exception tool to get those faster payments. Customers can pay you with their commercial card to get that receivable into your pocket faster. Remote deposit has really increased during the COVID crisis, as customers need to get their checks. Believe it or not, people are still writing checks in the United States. You don't see that as much globally. But they need to get those checks into the banking system fairly quickly. Number one, because we've all been quote unquote semi-quarantined into our house and don't want to make trips to the bank. So it'll allow you to deposit those checks electronically at a minimum by taking a picture of it with your cell phone if you have multiple checks, using those multi-scanners to get that into your cash flow system faster. And then more advanced solution like an integrated payable solution where customers can invoice their vendor partners or their customers and allow them to pay electronically directly from those invoices per se. So it's just all tools in vehicles to improve those collections and get that money into their cash flow cycle at a faster rate. Also, as an alternative for smaller customers and suppliers, they at times offer finance solutions. They'll finance those payables with their customers as an alternative as well. As James mentioned, I'll touch base on this quickly as well. It's also important to closely monitor your inventory, your daily demand versus your supply. It's very critical and important to ensure that cash is not, quote unquote, wasted on extra inventory. You want to keep it as tight as possible versus just having extra inventory laying around the warehouse or wherever you have it stored, and not giving you the opportunity to turn that inventory into faster collected cash. So it's very important to monitor that. In today's times, we're also seeing a lot of our corporate commercial customers drawing down their credit facilities, their lines of credit, to provide that extra liquidity in their operating account. As there's some uncertainty on what the future would be, they're drawing down on those to give themselves some extra protection, some extra liquidity to play around with from a liquidity standpoint. Also, we all know and familiar with the programs that our government passed as far as the COVID solution package, that being the Paycheck Protection Program, also known as PPP by the Small Business Administration, provided, for lack of a better term, a stimulus to small businesses, companies, nonprofits, to help cover payroll and operating expenses for 60 days. We've got another program coming up called the Main Street Lending Program that's going to be available to our commercial corporate clients as a stimulus package alternative as well. And then, of course, I don't want to steal Rory's thunder, but he is going to highlight factoring in its entirety after I get through. I mentioned the necessity to improve forecasting is critical. It's key. In order to maintain access to liquidity, you have to forecast appropriately to get there. Okay, communication, internal communication with your partners is key. At a minimum, Treasury departments are at least tied at the hip with the finance group. I know that's the case here from the banking perspective. Typically, you're tied at the hip with your tax and your audit group as well. So really collaborating and communicating with your internal partners to understand what your fixed expenses are, what your variable expenses are, et cetera, and communicating very tight on that is key for you to forecast appropriately and to manage liquidity in the future. Use of technology is also key. At a minimum, I believe everybody is using at least an Excel spreadsheet to forecast, but a lot more of our sophisticated customers have Treasury workstations to automate that process for them as much as possible. And it's also important to realign your expectations, recalculating budgets, et cetera. Expand your time horizons on your forecast, horizons being short-term and or medium to long-term. A short-term horizon could be as simple as an end-of-day balance. You want to know as early in the day what your end-of-day balance is going to be. And then more important, your medium to long-term, as I've been referencing, it's important to partner and collaborate with your partners to understand what you need, what data you're going to use to help forecast appropriately during these times. Flatten expenses. I will be brief on this slide as James covered most of that. We're seeing lots of companies doing hiring freezes. So for those positions that are open and existing, companies are taking a hard look at those, really so they can delay that the expense of it, preserving that cash. A natural result of COVID, obviously, has been pretty much the elimination of travel and entertainment expenses. You see no travel, no entertainment, everything's happening in a virtual call as we're doing today. Hopefully you're collaborating with customers' prospects effectively in this environment today. That's really eliminated most of the travel and entertainment expense, which has been a good result for a few reasons, not ideal, but a good result. And we're seeing a lot of companies delay those capital expenditures as well. I guess unless you're Denver International Airport, they've got tons of cash and are speeding up their capital expenditures during these slow times. So it could go both ways. And then finally, I will end with mitigating risk and fraud. As I mentioned during my open, during crises, especially in these times, cyber criminals are looking at this as an opportunity to really take advantage of customers and people in their most vulnerable positions. So it's really important that you're doing everything that you can to protect against that fraud. The last thing that you want to happen is to lose liquidity because of fraudulent activities. The bank provides a lot of those products, just mentioning a few: positive pay, ACH positive pay, callback procedures on wires. If you're issuing a wire to the bank, have that bank call back an authorized person different from yourself to make sure that this is indeed a wire that was intended to be sent out. I just read something last night. Google experienced 18 million malware and phishing emails related to COVID, and an additional 240 million spam messages about the pandemic. So you can imagine that the fraud the attempts are ever increasing. So you want to make sure that you are utilizing your best practices, having dual control at a minimum, have your virus protection software up, not clicking on links that are unknown to you, separation of duties, have employee A authorize or initiate a transaction, have employee B, even better, employee C, monitor and review that transaction before that money goes out of the door and that liquidity goes out of the door, because it would be critical to the business if liquidity is lost because of fraud and potentially could shut down the business. So I will stop there and hand it over to the next presenter.
Thank you, Tyrone. We sure appreciate your insights. Before I introduce Rory, I want to remind the audience that we do have the Q&A panel open, so send those questions in for that portion at the end. Rory Jaret is Vice President and Accounts Receivable Relationship Manager at Vectra Bank. He's in a unique position to help clients during difficult financial times. Using skills and tools such as accumulated benefit obligation and factoring, Rory is able to help provide customers with capital that most banks would not ordinarily be able to do. He holds a bachelor's degree at Colorado State University in finance and economics and has been in the financial industry for 13 years, with the past 2 being at Vectra Bank. Please welcome Rory Jaret.
Oh, thank you so much, Jeff. Appreciate the introduction. And as I'm getting here, get my slide. Good morning, everyone. Hope all of you, your families, your businesses are staying safe and well during these unprecedented times. Thank you to James and Tyrone for that wonderful piece of knowledge. You kind of let it perfectly kind of put it right down the middle for me to hit it out of the park here. So hopefully I don't disappoint. But as we get started here and we're talking about managing our cash through this crisis, we've all been experiencing the effects and the challenges of the pandemic. And it's more important than ever that we come together to help one another through these difficult times. So my goal this morning is to hopefully provide your businesses with some available options, some resources that address these challenges that you are or may be facing. So maintaining cash flow and working capital is one of the biggest problems that many small and mid-sized businesses experience. And couple of the reasons businesses are challenged is because they have slow-paying clients, and especially with this pandemic, we're starting to see some of your clients asking to extend terms. And then also we have unexpected financial events just like this pandemic that we're all experiencing. At Vectra Bank, our invoice factoring and ABL have changed the traditional models of lending to leverage today's technology and help businesses through these unexpected events. And in fact, we've kind of created we've kind of dissolved the factoring as being the F word around here. So as I get started, in my experience in the industry, most of the business owners don't really think of factoring. And it's largely because either they're not aware of it, they don't have time to do the research to get more knowledge about it, or they possibly have heard negative feedback from other businesses, other owners, possibly maybe some experience in the past. So today I want to kind of give you a better understanding and clear up any perceptions that you may have regarding factoring and ABL, and how here at Vectra, how our clients are able to utilize our tools and solutions to deal with these different business cycles. So kind of what I'm going to go into is the factoring as my first part, and then lead into the ABL at the end here. So as we look at factoring, kind of how does that process of cash flow work? Essentially, you have a good or service that you produce or provide. And when you've provided that good or service to your customer and you invoice, we basically purchase that invoice from you at a discount, providing you immediate cash of a percentage, generally about 85% on invoice, as sold to the bank. We then set up a lockbox and we collect on your receivable through that lockbox. So if we have $1,000, I'll give you an example. If we have you have $1,000 invoice, and we're able to purchase that invoice at 85%, we're going to give you cash today or tomorrow for $850. Once that $1,000 is sent in from your customer, that'd be 30, 40, 60, possibly 90, 120 days. We then retain our $850 that we gave you at the sale of the invoice, and then that invoice is then processed, and then the remaining $150 is back into your operating account minus the discount fee. So some of the basics of factoring is it's kind of unique and flexible in the fact that you can purchase specific business-to-business invoices. So if you may have 10 invoices that you have outstanding, and based on what your needs for cash flow is, you can either sell 5 of those invoices, all 10 of them, maybe one of them. It's really based on what your need is to address that cash flow or the shortage of cash flow. Also, what's another flexible part and basic of factoring is there's no financial covenants. Again, generally we advance 85% on invoice. We've set up the lockbox through the bank. We don't put any terms on our particular factoring lines, because really our philosophy is to get you to traditional financing, if that's what the goal is, that's what your goal is as a business. And so we don't want to hinder that by putting any type of terms. So if you're factoring with us for 8 months and we're able to provide you financing in 10 months, and we want to be able to get that traditional financing in place. And we also utilize technology for verification. I think that's one of the main differences, especially here at the bank, that I think a lot of perceptions of factoring might have is, traditionally, and maybe old school factoring, maybe some of the smaller shops, you had the verification was the bank to call your customers to verify. Well, since there's a lot of big corporations now, small, mid-sized corporations also have portal access that we're able to view to gain that verification. Or if there's not, then we try to utilize email so that we're not hindering that relationship between you and your customer. So why do companies factor? And really, there's more reasons that I have here, but these are kind of the general ones. Either you're a startup business or you're new. You have limited financial history. As you know, banks, when we're talking about traditional financing, we need historical financial data. So factoring allows for forecasting, or if you have contracts or work orders, purchase orders, we're able to provide that capital for you if you're a startup. Or maybe you're a business experiencing high growth rate or a hockey stick growth rate. And so you've had some traditional financing, but that traditional financing isn't able to keep up pace with the growth that you're experiencing currently. Or it could be in an industry very similar to the energy industry that's experiencing a downturn, or effect of a pandemic like we are now. Or maybe you possibly have, as owners, you have some personal credit issues from the last recession. Or I would say the last main reason why companies factor is the heavy concentration of maybe one or two customers that doesn't allow for traditional financing. So some of the other benefits of factoring, we have a kind of a unique, I would say, position here at Vectra, where we can actually do what we call carve outs. So you may be able to have some type of traditional line in place, but because of, again, maybe some concentrations with some certain clients of yours, that those concentrations aren't allowed in your borrowing base. So we're able to kind of carve those particular clients out, or invoices or accounts receivable out, and still provide you that traditional line, but also give you the capital that you need to address those concentrations. And again, I think this is kind of goes back to my one point, gap financing. We're really here to provide that gap to traditional or organic cash flow. And so our average clients here are usually with us about 12 to 36 months because they've graduated generally to a traditional financing path at that point. And then most importantly, it's an immediate bump to your working capital. As James had mentioned, it's an immediate bump to your working capital to assist in maintaining those cash flows of either slow paying clients or unexpected financial events. So kind of questions to ask yourself as you're going through your business strategy is, does your company regularly receive invoices from clients that are being paid late? Are you relying on payments from one order that's already completed in order to fund the next? Is your bank reducing your current revolving line or possibly even terming it out? And is your business unable to obtain traditional lines of credit to support your cash flow needs? So as we go through, the next areas are what we call asset-based loans, or ABL loans here at Vectra. And kind of what an ABL loan is it's essentially, it's a revolving line of credit, very similar to a traditional line tied to a borrowing base. The kind of the difference between the two is that our primary source of repayment is conversion of assets to cash. So we're really looking at the collateral. And when I mean the collateral, we're looking at accounts receivable and inventory, very similar to what James had spoke about on the inventory side. And then our secondary source of repayment is cash flow from the operations. On traditional borrowing-based lines of credit, that's kind of a flip. Really, the cash flows from operations is our primary source, and our collateral is our secondary source. But the ABL does provide several advantages. It provides incremental liquidity tied to working capital. It is definitely flexible, more flexible on covenant restrictions than a traditional revolving line. Possible flexibility to personal guarantees on some of our well-structured loans. Again, there's some flexibility and some rapid growth. And I think this is one of the largest benefits to ABL, is it provides seasonal funding for inventory into the selling season. So if there's inventory needs and you have Q4, Q2 that are your biggest months, how do you provide that capital for those preparations? Ability to work through cycles of operational challenges, and can be competitive with your cash flow significantly less than junior debt or equity, right? So those are some of the, I would say, key advantages of ABL and kind of what ABL looks like. I said, it's very similar to a line of credit. So I'm gonna kind of do just a quick lending breakdown between the three, all right? And I'm gonna kind of start, I know traditional revolving lines at the bottom, but I'm gonna start with that. Your traditional borrowing based or revolving line of credit is definitely your lowest cost of capital. And like I said, that's generally the ultimate goal here at the bank for our customers to get to, if possible. But because it is the lowest risk for the bank and lowest capital, there's more restrictions and covenants placed on traditional lines, and more strict credit policy. So if we're not able to provide that traditional line, what are our next two options? Well, again, it's the ABL. So the ABL is very similar, as I mentioned, but it has additional monitoring fees. So it's going to be a tad little bit more costly than your traditional lines because of those monitoring fees, but it also allows less strict financial covenants and is more flexible to credit policy, to growth, and to economic downturns as we're experiencing. And then lastly is our invoice factoring, where it is going to be the highest cost of capital between the three, but also there's no financial covenants, provides a ton of flexibility with credit policy, with growth, and definitely through these tough times that we're all experiencing. So I kind of wanted, as I'm ending up here, and I want to catch up on our time here, I kind of want to leave you all with something that, you know, I learned from my days of playing hockey that can be applied to life and to our businesses is that a person's, or in this case, a business's character is not judged when they are down. A person or a business's character is really judged on how they get back up. Here at Vectra, we're here to help you get back up and assist your business through it and to be successful through these trying times and pandemic. So I want to thank all of you today for your time. I want to thank BizWest for putting this on. James, Tyrone, thank you for all of your wonderful knowledge again. And I hope all of you have a wonderful, blessed day.
Awesome. Thanks, Rory. Really appreciate that. Folks, it's time for our Q&A session, and we've received about 5 questions from our audience today. The first is this one, and I'll let you guys kind of decide who to answer because none of them are directed at anyone in particular. Suggestions for clients concerned about obtaining credit and sustaining good credit. What do you guys have on that one?
James, you want to take that one?
Yeah.
James or Rory?
Yeah, do you want to repeat the question real quick, Jeff? Sorry.
It is, what suggestions do you have for clients concerned about obtaining credit and sustaining good credit?
I mean, I guess I kind of take a little bit of that. So what are the suggestions of sustaining credit? Really, it's looking at, and I think, and actually, James, you can even touch on this as well, is really looking at your processes that you have in place, and creating the most optimal and efficient. And I think actually this is probably for all of us here. What is the most optimal and efficient way of managing your processes, your staff, your employees, to give you the greatest return, right? And to be profitable. I mean, that's the key. But there are ways, and that's kind of what we do here at the bank is definitely work with you, build a strategy. So if you're not traditionally bankable, how do we get you there? And then what does that game plan look like, and kind of take that step by step. And it's utilizing partners like James and Plante, Moran, and the bank, and maybe some other resources out there to help you as a team to kind of get you there. I don't know if you guys want to add anything, Tyrone or James.
Yeah, I'll make a quick comment. I would say understanding what the bank needs to see and what they want to see is important. Coming prepared with either a detailed financial forecast and really presenting yourself and the business in the best light possible will really help enhance that relationship with the bank and give the bank more comfort in lending to you. So I think oftentimes if you don't have a financial model or you're unsure what the bank's going to look for, it's best to find that out ahead of time so you go in prepared.
All right, thank you. The next question is, how does gold play into the cash and investment strategy?
I don't know if I necessarily have an opinion. James, I'll let you take that one.
I would just say that if you have the liquidity to invest in gold, that's great. It's probably good. The question is probably related to safety of capital in anticipation of a significant economic downturn. It's not something that I typically recommend. I would say that's kind of more on the fringe. But if you do have, the need for safety, it could be an option as long as it doesn't impact the liquidity need for your business.
Anyone else?
I think James said it perfectly.
The next question is, have you noticed a huge increase in card payments?
I'll take that one. I wouldn't say a huge increase because a lot of expenses are down and not a ton of increased card activity. But I'll talk out both sides of my neck here and say, yes, we have seen more utilization of card payments as a source of additional working capital. Again, as I explained in my presentation, to take advantage of discount terms, et cetera, but overall, not a huge increase. It's kind of leveled itself out.
Okay. The next question is for small business. Are there other POS systems besides Square that have lower fees yet simple to use?
Yeah, I would encourage you to partner with your bank on their alternative solutions. There are several viable solutions out there that rival Square and are a better solution than Square from a confidentiality, data protection, PCI compliance type perspective. So I would encourage you to partner with your banks to explore those options, yes.
Okay. Another question just came in. What should we expect from customers in terms of payment? For example, pay on order versus pay at shipment or receipt. Who would like to take that one? James, do you have an opinion there?
Yeah, I think what you can expect from customers is, they're all going through the same struggles that we are, and they're trying to manage their cash flow using a lot of the same techniques that we spoke about. So I think it's going to come down to a conversation with that client and really negotiate what is a good middle ground for both. It's really a timing issue on payment. So ideally you get paid on shipment, but in this environment, you may have to be more flexible in your terms.
Okay. And I know we're getting a little over our time here. Here's the last question. Can a commercial card be used to better manage cash flow during this crisis?
I'll take that one, and I will say absolutely from both sides of the equation. As I mentioned earlier, you can use a commercial card to take advantage of discount terms and pay that early and extend your payables from a working capital standpoint. But then on the alternative side, those customers that are paying you via commercial card, you're getting that receivable into your cash flow sooner than you typically would. So yes, it's advantageous on both sides of the equation.
Okay. Well, folks, I'm going to wrap it up at this point. We want to be mindful of everyone's time. I do want to encourage all of our attendees to answer the survey that we'll be sending you with slide presentations that will serve you all in the future. I want to thank all of you for attending today. Of course, I want to thank our wonderful presenters, Tyrone, James, and Rory. And everyone, please stay safe and enjoy the rest of your day. Upcoming events for BizWest, Women of Distinction on August 26th. All right, that's a wrap. Have a great day, everybody.
Take care, everyone.
Thank you.
Thank you. Take care.